Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Kenneth Jeffrey Marshall. Kenneth teaches value investing at the Stockholm School of Economics in Sweden and at Stanford University. He also teaches asset management at UC Berkeley. He holds a BA in economics from UCLA and an MBA from Harvard and is a longtime value investor. Today we're going to be discussing his book, Good Stocks Cheap: Value Investing with Confidence for a Lifetime of Stock Market Outperformance. Let's ask Kenneth 5 good questions. But first, I'm happy to announce my literary debut, The Rebel Allocator, is now available on Amazon in both print and digital formats. You could say it's about time. I've been pouring my heart into this book for more than 3 years. A well-known SoCal billionaire received an early copy of the book and actually called me to say he enjoyed the story and was adamant that I get it made into a movie. Talk about a surreal experience getting 20 minutes on the phone with one of my heroes. My friend Tobias Carlyle had this to say: Jacob Taylor has written a modern-day investment classic. The Rebel Allocator is reminiscences of a stock operator for value investors. It's a fictionalized retelling of the lessons in The Intelligent Investor in an accessible page-turner. If you want to learn how to invest like Warren Buffett by sitting at his knee, this is the book for you. Wow, how flattering is that? I was blown away when he sent me that. I've created dozens of ad-free author interviews over the last 5 years and never asked for anything in return. If you've gotten any value out of these efforts, please do me a personal favor and pick up a copy of The Rebel Allocator. I promise you won't regret it. And now, on with the show. Welcome back to the program, everybody. My guest today is Kenneth Jeffrey Marshall, and he's the author of Good Stocks Cheap. Hey, Ken, thanks for taking the time to be with us today.
Hi, Jake.
So, just a little preamble before we hop into our actual questions, but there were a few things that I absolutely loved about your book that I was not expecting to love as much as I did. I was pleasantly surprised by it, and I mean that in the most warm way possible.
It's received in the most warm way possible. So
yeah. So one of the things that I liked, and that kind of drives me secretly crazy, is that people conflate price and value when they're talking all the time. And one of the things that you said is that I when I read it right away, I thought, oh my God, of course. How come we don't call it enterprise price?
I don't know.
Instead of enterprise value.
Yeah. The funny thing is, language really drives behavior.
Yeah.
And so if you want the right behavior, you really want the right language. And, these little terms that are incorrect and misleading sort of sneak their way in to the investing vernacular. And before you know it, they sort of hijack reason to cause behavior that's not particularly constructive. Another simple one like that is people will use the gerund when they mean the past. So they'll say, if a company had earnings, if a company paid a dividend of such and such amount, people will say it's paying a dividend. Well, is it? We don't really know because the next quarter hasn't happened yet. But that's another example of it. That's right, Jake.
Right. Another thing I liked that you did was that you described that multiples are a shorthand and that there's actually a lot of dangers involved with using a shorthand like that. And I think a lot of times we get so busy just talking and trying to talk about the same number when you're talking with someone about an investment that maybe we're not even referring to the exact same thing when we talk about earnings, for instance. Like that could be all kinds of different things.
It could be all kinds of different things. It could be operating income. It could be earnings before interest and taxes, or EBIT. It could be pre-tax income. It could be after-tax income. It could be normalized earnings. That's right. So when you're talking about something like return on invested capital, people use different numerators. People use different denominators. It's one of the reasons why when I do my analysis of a company's historical performance, I don't take any of the off-the-shelf calculations given to me by any of the third-party information service providers or even the company itself. I'll just calculate it myself because there's always the question of how much cash did they subtract from the denominator, or did they subtract all intangible assets in the calculation of invested capital or capital employed. So you're right.
Yeah, there's so much subjectivity that can creep in there. So, all right, question number one. Let's get into this. Now that we got that out of the way, can you walk us through how you built your investing model? And I especially liked how you really stripped it down to some core essential ideas, like organizing your efforts around know what to do it, and then don't do anything else.
Yeah, that layer of the model came second. What happened was I was scheduled to start teaching an introduction to value investing class at Stanford, which I still teach. And I had to come up with some sort of flow chart for what I actually did, which was not particularly original. It was nothing other than a distillation of what better known value investors have been using for decades. But I realized that sort of the first step was to make sure you knew what you were looking at, or what I call in the model, do I understand it?
Right.
And, Peter Lynch has said, buy what you know. But to Peter Lynch's characterization, I think that guidance, as well-intended as it was, got misconstrued to mean buy stock in companies whose products you're familiar with.
Right.
That's a piece of understanding it, but it's probably not the whole litany. There's probably more. And as I see it, there's sort of 6 parameters you want to define. What the products are, customers, form, like legal form, industry, geography, status. If you can nail all 6 of those down, the probability that you don't understand the company you're looking at is 0. That's my kind of probability. And most investors don't take the time to understand that stuff fundamentally. So that's sort of the first thing I realized I do. And then the second thing I realized I do is I try to figure out, is it good? Regardless of what price I may have paid for it, is it the kind of thing that I would be comfortable having in my portfolio for decades? That's split into 3 parts as I saw it. Has it been historically good? Does it look like it will be good in the future? And is it shareholder friendly? And I break that down in the book, but essentially, has it been historically good is nothing other than looking at the historic financial statements and calculating things like we were talking about, return on capital employed. That's fairly easy relative to the other things. Mm-hmm. Will it be good in the future? Is things like Porter's 5 forces analysis. There's 4 tools that I introduce in the book for this. And then is it shareholder friendly? That's about compensation, director and officer ownership, dividend policy, any related party transactions. But if you bundle those 3 things together, you wind up with the second step. Is it good? Mm-hmm. So do I understand it? Is it good? And then the third step is it cheap? Now, usually when you're looking at something, the probability that it happens to be cheap at the second you're doing all this analysis is pretty slight. So what you wind up doing is calculating at what price it would become cheap. That's a quantitative calculation, obviously. And I think long-term value investors wait for it. Sometimes years. Sometimes it never comes. But if you have sort of, 100 names or 50 names of companies that you understand, that you think are good, occasionally one of them, for irrational reasons, is going to become cheap. So that was the first sort of level of the value investing model. And then I realized that that whole piece was kind of the first step in a layer above that, mm-hmm. which is what you referred to. You start with, know what to do. Well, the way you know what to do is by figuring out if you understand the business, if it's good, and if it's cheap, or at what price it becomes cheap. That's knowing what to do. The second step of that top layer is do it. There's these moments when some great company goes on sale. And what you don't want to do is to, dawdle and revisit your analysis, start taking the dropping market price as an indication that maybe your assessment of quality was wrong or something like that. Yeah. It's better to just kind of buy it, right? So that's the second step of the top level. And then the third step, very importantly, which almost no one can follow, is don't do anything else. Yeah. Right. So this means not taking these, low expected value bets, right? So if you want to angel invest, have a good time, but
don't please call it value investing or
totally. And I think that's more consumption activity than investing activity. People understandably like interacting with bright young entrepreneurs. They're talented people. They're fascinating. They have fascinating histories, wonderful ambition. But on balance, that kind of investing does not play out terrifically well. So after I kind of codified all that, I presented it in the first Stanford class, and I would say it resonated pretty well, and there's been almost no changes since then, and no changes since the books came out.
So question number 2, your book really demonstrated a very clear understanding of accounting, and I was very impressed with the way that you were describing different accounting phenomena. So to ask an expert of accounting, which I now consider you, has the rise...
I think you honor me inappropriately, but go on.
Well, let's see how you handle this one then. Has the rise of intangibles changed how you use and interpret financial statements? There's been some pretty good books that have come out the last couple of years about how intangibles are impacting financial statements, and I'm curious, has it changed your approach at all?
It has a lot to do with the way that I calculate capital employed.
Okay. Which
is often known as invested capital. They're slightly different, but same basic idea. Historically, the way you would calculate invested capital or capital employed, one way is to start with total assets, subtract non-interest-bearing current liabilities, subtract cash that's not necessary, which is usually all cash, the way it's normally done. And then you would subtract intangibles. So when people came up with a capital employed figure, it was typically a tangible capital employed figure. Mm-hmm. The idea being that if a company paid more than book value for a business it acquired, it won't have to pay that goodwill again. Okay. If you look at a lot of companies today, particularly those in high technology spaces, they will often acquire other businesses just to keep their product line fresh. So Cisco, for example, is sort of the perennial example of this. If they do 15, 20, 22 or whatever acquisitions a year, it's often of companies that are in high technology or heavy research and development budgets. Mm-hmm. The true worth of those entities often is not reflected in assets minus liabilities or the book value.
Yeah, the assets aren't capitalized very, very often.
Very good. And so you wind up with Cisco paying predictably more than book value for these companies. And so you wind up with an enormous amount of goodwill as a percentage of total assets on Cisco's balance sheet. Now, do we want to pretend that that goodwill did not reflect an expense that Cisco had to incur in order to support its operating income? I think that's a stretch. And so I don't summarily subtract intangible assets from total assets when I'm calculating capital employed. So that's probably the way that it manifests itself most strongly in the way that I think about it.
That's interesting. Did you think that, have you ever, I've considered this before of, can I kind of peanut butter the costs of a lot of these fixed costs of a high-tech company, which is kind of how they typically run, and then spread them out over even like a 5-year depreciation or something to try to normalize those expenses a little bit more as if they were tangible, kind of an old school, if you were running a chemical factory instead of making software.
I'm kind of stuck on your use of peanut butter as a verb. I think it's fantastic. I want to include it in my next piece of writing. But give me that again. I think I'm missing you.
Okay. So right now, with the accounting standards, all R&D basically for high tech is pretty much run right through the income statement. There's no capitalization of those expenses.
It's in-house R&D.
Right.
Yeah.
So I've wondered before if maybe you can get to a more economic reality by spreading out or peanut buttering those expenses over maybe 4 or 5 years of life of them, we'll call it.
So you're wondering, would that be a better accounting policy, a better accounting treatment?
I mean, for an investor to try to get closer to what they think of economic reality and the actual life of an asset, and should it be on a balance sheet or not?
I hear what you're saying. I don't know if that would make accounting better. I mean, accounting is good at describing most businesses, but it's not perfect at describing any business. So regardless of what financial statements you're looking at, you're going to have to do some calculations to figure out what's really going on. Sometimes it involves normalizing earnings, which is essentially what you're talking about.
Yeah.
Would that be better? I mean, could FASB figure out a good generic way to handle that? Or is it better for individual stock analysts to simply figure out if they want to spread things out? One of the issues I have with the suggestion, Jake, is that a lot of these companies that do such intense R&D are doing that perennially.
True.
They're doing it perennially. So it's kind of like, in Vermont with a covered bridge. I mean, they paint one side this way and they paint it the other way. They're just always painting it.
Right.
And so to me, it's almost like an operating expense. So in other words, I don't know that if you have a company that's been around for a while, it might be different with startups, but if you have a company that's been around for a while in technology, I don't know that it's, so wrong to disregard R&D expense as an expense when it actually happens. If you have a brand new firm that's gone public and now you have to figure it out and it's still kind of getting its initial product releases together, it may have some products out earning revenue and there's earnings, but that's where it gets a little bit tricky. So if Lyft goes public soon, which is
supposed to
many folks think to happen, if they have a lot of products in development and they're incurring intense R&D expenses, that would be a situation where that gets difficult. But it's so hard to figure out how to spread it out.
Yeah.
I mean, you would need management level knowledge for how it's going to go. And so many R&D projects don't work.
True.
And that,
Yeah, it fails the conservative policy of accounting in a lot of ways.
It does, but sometimes thick application of the conservatism policy causes you to miss opportunities that you probably shouldn't. So
right.
It's very hard to answer. I would have to look at, I don't know that FASB can do a better job than, and this is nothing against the people on FASB. They're very well meaning, but I think it's up to us to sort of figure it out by ourselves.
Yeah, I agree. So question number 3, there have been some great studies and white papers on specifically reversion to the mean on returns on invested capital. I'm thinking my favorite one is probably Malbosen's work on base rates that are out there.
Yeah.
Does that idea of mean reversion in maybe a specific industry impact your strategic assessment? And as a follow-up question and a bigger kind of macro question, do you think we're ever going to see profit margins revert back to the mean again? I mean, we've been way over it now for quite a while, but it is a data set that historically has been pretty mean reverting.
Yeah, some companies have some sort of moat that kind of enables them to keep above average return on invested capital. So, Porter would suggest in his, long ago piece on 5 forces that maybe the average return on invested capital in the United States is something like 15% or something like that. But there's companies that are much more. If you deduct all cash, there's software companies that have 100% return on invested capital. And Porter's return on invested capital is essentially calculated the same way I calculate return on capital employed in the book. So I'm with him on that one. There's some companies that have something special. They do smart things. They have some sort of special love from their customers that keeps their customers from considering alternatives. Those companies might, enjoy sustained above average return on invested capital. Other companies with high return on invested capital are simply first to market, and they have no particular moat protecting their space. And I think you can kind of see that. I mean, I apply the tools in my book every day, and I see situations like that. And, you have to expect those things to mean revert or even go below return on invested capital. So it depends. As for a general statement about, mean reversion, I don't think that way. I just am always considering individual companies. And so these broader picture issues, there are smarter people than me who can give a more useful opinion than I can on that.
Fair enough. So question number 4, one of the biases that you identified in the book, you called it miskontrast. And I really like that one. Maybe you could explain what it is. And then maybe I'll have maybe a follow-up question as well. So maybe start there.
It's funny. I didn't intend to create words, but there were these concepts that have been around investing for a long time that seem to lack names.
Right.
And particularly if they pose a risk, it's important to give it a name so that you can identify them early and not get tripped up by them. And miskontrast was one of them. Miskontrast is a situation where something looks good, even though it isn't. It just looks better than the other stuff. Mm-hmm. So a wonderful example would be in pricing. If all the stocks are trading at a price earnings multiple of 40 and something drops to 30, it may look relatively cheap. But in an absolute context, I mean, barring some sort of unusual situation, a PE of 30 would not be particularly cheap. So it would be miskontrast to identify that PE of 30 stock as being inexpensive. And it's so easy to forget this. Yeah. Particularly if you work in a financial center or you're hanging out with investors all the time, because the social reinforcement for sort of picking the most attractive fruit at a particular time, regardless of how ugly it may be, the social impetus for that is extraordinarily strong. So you have to keep these absolute levels very much in mind. But that's miskontrast. And I've been happy to get some good feedback on that term. I think with a name, we're better able to keep it from hurting us. So.
Yeah, I agree. Having that on a checklist is
totally.
is a really helpful thing. And I have to, maybe I'll get a little bit of flack from my fellow value investors, but I have to be honest that a lot of the 13F ideas or other ideas I hear, when I've looked at them lately, I feel like miskontrast is happening in a big way the last few years. Like, it looks relatively cheap, but that doesn't mean on any historical basis that I find it particularly attractive. Maybe my question for you would be, do you consider yourself an absolute or relative value investor? Or is that even a false dichotomy?
It's not a false dichotomy. I think that I only measure my performance over the long term. If you measure it over any period of time less than 3 years, That's sort of silly because that would be benchmarking against the vicissitudes of psychology as opposed to, anything real.
Yeah.
So I'm relative, but only over long periods of time. So I benchmark myself against the S&P 500 total return. I figure if Berkshire Hathaway benchmarks their performance against that, it's good enough for me. And of course, what's critical is whatever you benchmark yourself against, don't change it.
Yeah.
Don't change the benchmark. And the temptation to do that is incredible. We know of companies that do nothing other than create bespoke indexes that are sort of, with a wink, designed to be beaten. Mm-hmm. So in the book, I talk about how this is sort of like the basketball team that the Harlem Globetrotters travel with.
Right, yeah.
The Harlem Globetrotters, this exhibition basketball team, to showcase their skills and how funny and wild they are with their basketball. They travel with this team called the Washington Generals. And the whole purpose of the Washington Generals is to lose.
Right.
And sometimes it feels like these bespoke indexes are like the Washington Generals. They're just sort of designed to be beaten.
Fall guys.
Exactly, fall guys. And so the idea, I think, for anyone who wants to serve their clients or their family or whoever they're investing for, is to pick a standard benchmark and stick with it. So I would say relative, but only over long periods of time. And I would say that the longer the period of time you pick, the more absolute your relative comparison becomes.
Right. Yeah, exactly.
But I mean, how I did last quarter or last year, I could not care less.
You must not be managing other people's money then. I'm just teasing. Okay, so question number 5. What are the ancillary sort of non-monetary...
Can I comment on that? 'Cause, no, you have a good point there.
Yeah, go ahead.
This is a very big deal. I mean, this is what's tough about running outside money as a real value investor.
Yeah.
Is you have to deal with these folks that understandably respond to the only data they have, which is how you did recently. So how do you manage that? And, Klarman talks about this very elegantly. He says, and he's a much bigger authority on this than I am, he says, you want the kinds of investors that when prices go down say, can I commit more capital so we can take advantage? Mm-hmm. One of the reasons Berkshire's stock price was kept so high forever because when they didn't have the Bs was they didn't want hot money coming in. So there's ways that you can signal that you're in it for the long term, but it's a trick. It's a trick. Yeah. I apologize for interrupting you, Jake. But
no, that's a good point. I was just making a kind of throwaway joke, but you're right.
It's for real.
It's real. All right. So question number 5. What are the ancillary sort of non-monetary benefits that you found to being an investor? I really like that little part of the book as a reminder of, like, it's not just always all about money here.
Well, I should be clear. The main thing is it is remunerative. I mean, that is the main thing that attracts me and most folks to the space. But if you're a long-term value investor, I think you get this chance to look at these amazing things that teams of people have done. One of the things that happens as you grow older is you become sort of known as an authority in some subject. It could be a particular branch of medicine or engineering or something. And you come to be regarded as an expert. And you like that treatment that you get. Mm-hmm. People listen to you. They respect what you do. But the cost of all that is you lose this sort of license to be naive. And if you remember when we were in college, if you wanted to take a class in Greek classics about which you knew nothing, or astronomy about which you knew nothing, you could do that. And no pride was lost. You were a college sophomore and you wanted to explore something new. As we get older, that sort of license slips away. But if you're a long-term value investor, I think you have sort of a requirement to sort of continually put yourself in these very dark rooms and try to turn the light on, like try to figure it out. So recently I looked at a company that makes vaccines. In Australia, it used to actually be a division of the Australian government, but went public as its own company. And this required me to know a tremendous amount of biology, in which I have no formal background beyond high school, actually. So this has to do with human blood plasma collection, why that's important for making vaccines. But as you do all this stuff, you get to revisit everything that Homo sapiens have figured out about biology. And you get to study the work of these people that figured out how to save people from dying from animal bites. I mean, that's sort of a pinnacle of human accomplishment, isn't it? That's amazing. That's amazing to me. So you get, I think, to your question about non-monetary benefits, this sort of regular dose of wonderment that keeps you sort of childlike in the best way. So that's probably my favorite thing. That's probably my favorite thing. And that's just not for accomplishments at the top, by the way, the top of sort of science. when I studied Kone, the Finnish elevator company that I write about in the book, it gave me a chance to talk to people that repair elevators. Try having a civilization without people that repair elevators well.
Right.
And just to find out what kind of special tools are required, how much education they need to do the work. These are serious people doing important work, and it's fascinating to interact with them. So that's something I love about it.
Yeah, and I think that kind of ties in a little bit with the circle of competence, where if you stay within yours, you're allowed to have a childlike wonder to all the things that are outside of it, and not have that expectation that, I have to know everything about the world to be the best investor in the world.
Totally. When I like nothing better than to be the least informed person in the room, just to be around people that are very gifted in some space. I was looking at a company they farmed salmon in the North Atlantic. It was a company that made salmon through salmon farms. And I was stuck on an issue of pathogens that had, at that point, harmed a harvest of salmon in South America for the whole season. And around that time, we went to a friend's house for a child's birthday party. And the father in the family turned out to be a postdoc in fish pathology. And I would not let this guy go.
Yeah.
Everybody's like eating ice cream, and I want to talk about sea lice. And, it was perhaps socially ungraceful, but I mean, it's fascinating what these folks have accomplished. So I love that.
Yeah, no, I agree. That's probably one of my favorite things about it, too.
Right.
So bonus question we always ask, and this is for a book recommendation, and typically we're looking for anything that is maybe off the beaten path or at least maybe underrated in your opinion. So what do you got for us?
Well, there's a whole group of books that were written not for investors, but for other folks that have been sort of hijacked by value investors because they turn out to have such important lessons. And probably the best example of this is Cialdini's Influence, which details the psychology. And I think Charlie Munger brought this to light at a talk he gave at Harvard Law School like 2.5 decades ago or something. I would say that the next candidate for that kind of book is Factfulness by Hans Rosling. Dr. Rosling was a physician and a professor in Sweden who passed away recently. But his book was designed to basically deliver the message that the world is better than we think. And what he used as an example was data, census data, things like that, Center for Disease Control data, about infant mortality, literacy, death from natural disasters, to help us understand that a lot of these data points have gotten just much, much better. And his point was to sort of encourage everyone not to be so scared about the world. But the reason I think it's going to find itself into the domain of value investing is it reminds us how easy it is to have our opinions formed by tilted sources. Journalists, and I want to be clear, journalism is an extremely valuable profession that we would absolutely crumble without. But the fact of the matter is that when editors choose what to have articles written about, when television producers make decisions about what to cover, they will tend to pick outlying events. And so if we form opinions about which stock to follow or which industry is hot based on media reports, almost by definition, we wind up with a tilted view of the universe. If we just kind of use data to figure out where to pay attention, we will tend to make better judgments. Berkshire will make an acquisition of some company you never heard of. They're doing this all the time. So all the excitement will be around autonomous vehicles, and they'll buy some brick maker or something. So, I mean, we see this practice in the best investors' behavior. But I think that Factfulness by Hans Rosling will start to be regarded as something pretty useful for folks to take a look at.
Yeah, I agree. And I think, you're in pretty good company with the recommendation, because I think it was Bill Gates' favorite book of last year or something like that.
It's hard to get an original suggestion, that's true.
Yeah.
But it's interesting. The reason I mention it, Jake, is that my friends in Scandinavia know about it.
Yeah.
But here in California, it seems to be lesser known for whatever reason. So
the other thing that I like about that from a value investor perspective is that kind of one of the implicit bets that you're making when you're a value investor is that things are going to be gradually getting a little bit better. So if something is wrong, it's probably going to get fixed eventually, right? Whatever the problem is in an individual company or an industry or something. So you're almost always implicitly betting on kind of an optimistic upside when you're buying at peak pessimism, right? So So when you have a book like Factfulness that kind of tells you, you know what, the glide path of humanity is kind of on an upward trajectory still,
Right.
despite what you see in the news.
Yeah.
That feels pretty good then to maybe buy something that that would require that leap of faith that the world is getting a little bit better.
You're right. If you're a long-only equity investor, as I am, then you have to have a basic view that the population is not going to shrink, that longevity is probably going to increase, that consumption per capita is probably going to basically go up. That's what causes stock price values to go up over time. So, I mean, you're right. You do have to have sort of a basically positive attitude. The trick is to not become Pollyannish. Mm-hmm. And I think that this book, by driving home the importance of data, keeps us from becoming Pollyannish. We're more realistic. And yet, as you point out, Jake, we wind up with a pretty favorable impression of how things are going to turn out.
Perfect. Well, Kenneth, thanks for coming on the show today. It was a real pleasure talking to you.
Thank you, Jake.
All right, till next time. Before you go, do me the huge honor of picking up your copy of The Rebel Allocator, available on Amazon in both print and digital formats. It's a business person's guide to effective capital allocation, told in a coming-of-age story of a college grad who crosses paths with a wealthy Midwesterner. It's fiction for the nonfiction reader. Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.